The topic of Chapter 11 is equity. We've talked about assets. We had a chapter in which we talked about our fixed assets, our long-lived assets. We've talked about liabilities. And now we're moving on to equity, which is the third caption, the third major caption in your balance sheet, and is also the last part when we're talking about the accounting equation. We're going to have a number of voiceovers for this. The first one today, we're going to talk about rights and obligations of the stockholders and a little bit about the terminology that's involved when we talk about common or preferred stock. And then in the next two voiceovers, they will be talking about the stock transactions. And so there are quite a few different stock transactions to handle, and it's going to take two voiceovers to cover those. And lastly, then, we're going to do our financial analysis, and we're going to talk about the ratios and how we evaluate whether our company is doing well or not based on equity values. So we will have a total of 4 voiceovers on the PowerPoints for this PowerPoint. Now, one of the goals, if you're an entrepreneur and you're trying to start your business and you're growing and you're wanting to see into the horizon, and one of the goals you have in growing your company is to hope to become a corporation or to incorporate your business into the future. So you might start your business. I know some of you are very entrepreneurial. Some of you will start your business and you'll be a sole proprietorship. And then you'll decide, well, maybe I need to become an LLC, a limited liability corporation, where I do not have as much at risk, where I can separate the assets of my company from my personal assets. So let's become an LLC. The next step up from this is to become a corporation and start to think about raising capital. Instead of going to the bank and asking for loans, you're going to start issuing stock. And this just brings in so much money to your company. You can do so much more when you have that cash flow from issuing stock. That this is the goal. This is a goal of many entrepreneurs then, to be listed so that you can sell your stock on the stock exchanges. This corporate ownership, the major advantage then is in this ability to raise capital or to raise cash. You can use this cash then to grow your business, to expand it, and that's another one of the goals of most entrepreneurs. One of the advantages of this corporate ownership then is that people will want to invest in you because they know that they are easily going to be able to transfer that ownership. They can sell their stock to other individuals. If they don't want to continue owning stock in your company, they can sell it. And also, they do not have the liability associated with ownership. They own your company, but they don't have any liabilities beyond the potential for losing the value that they've invested in that stock. And whether it's a corporation can't go back and go after the ownership and take anything from them. So the investors have a limited liability, and so that creates a situation where it's really easy to get capital in if you're a corporation. And this corporation is a separate legal entity. It owns assets, incurred liabilities, and it can be sued. And when the corporation is sued, most of the time not even management is sued. It is the corporation that is sued. Not even the board of directors is sued. So it is the corporation that gets sued. And this corporation also has the ability to enter into contracts. So the corporation is a separate legal entity, and this is peculiar, I would say exceptional, in all the forms of business. So a lot of advantages to be incorporated, and one of the desires of most entrepreneurs is to become a corporation or to incorporate their business. In corporations, then, the ownership of the corporation are the stockholders. With common stockholders, these stockholders have voting rights. There are also other forms of ownership, which we'll talk about in addition to the common stockholders. We have preferred stockholders. This is common stockholders, and one of the benefits of the common stockholders is the ability to vote. And so each one of your shares would represent a vote. Now, the stockholders don't vote on everything. They only vote on certain matters, and the matters are brought before the corporation. They usually have an annual meeting, and the stockholders don't even have to be present. They can send in what's called a proxy and vote on the matters. Dividends are sometimes declared by the board of directors, which means the cash dividends or the stock dividends, we'll talk about that, can be given to these holders of common stock. Also, preferred stockholders receive dividends. Preferred stockholders do not have voting rights, but preferred stockholders can receive dividends. Common stockholders also have a residual claim to the corporation. So if this corporation were to continue or to discontinue at some point in the future, the assets of the company would be sold, the liabilities settled, and whatever is left over would be distributed to the stockholders. And that's what's meant by residual claims. Now, I consider equity to be just the best way to finance assets. In a previous chapter, we talked about a ratio, and it was called the debt to asset ratio. And we looked at a corporation and compared the amount of assets, the amount of support for assets that was coming from liabilities versus equity. Now we're going to talk about equity and why we really would prefer to have our financing from equity versus debt. This is my personal feeling on this. Others do not always agree with me, but I think equity is a wonderful thing because a company can issue stock, get the cash in, and we never have to pay that value of that stock back to the stockholder. A stockholder will have the right to sell the stock in the marketplace and get cash if they choose to do so in the future, which merely transfers their ownership to another individual. But we as a corporation do not have to pay it back. This is wonderful. It is like a gift. It is a gift. It is cash coming in. We don't have any commitment to pay it back. Now, dividends also could be paid, but they're optional. The board of directors has to decide whether they want to pay the dividends or not. They may not be paid. So, in other words, we can have a lot of cash coming into our corporation, and we never have to pay it back. And sets up this terminology that I've contributed, because it's like a gift. It's a contribution. Yeah. And it's a wonderful thing. So that is one of the primary reasons why a business owner would want to incorporate their business. Well, there are certain advantages of a debt, but as I said before, I don't consider them that great. One is that if you have debt, you are going to pay that interest, but you get to deduct it when you calculate your taxes. Now I'm saying, well, but with equity you don't pay interest. So I don't think this is a great advantage. And the other thing is, with debt, there's less control of the corporation. So the debt holders are not going to have a vote. There's no voting rights associated with owning debt of a corporation. So the company can do whatever it likes within bounds, within certain limits, and the debt debt would be different from the equity issuance because there are certain things with equity where a vote is required, and the common stockholders will have a vote. However, in most situations, There is no advantage or disadvantage from this debt versus equity and control of corporation. Now, in stockholders' equity section of the balance sheet, there are 4 major captions, so let's talk a little bit about those. In contributed capital, we talked about that. That's common stock, preferred stock, and this is when the company issues the stock certificates and the individuals send in their cash. A wonderful thing, contributions, just cash coming in. And I should say at this point that if a company wants to continue to be able to issue stock this way to get the cash coming in, what they need to do is to sustain their net income or have strong earnings. So there is a little bit of a restriction there. We need to keep our earnings up to be able to continue to issue our stock at a high price. Retained earnings we've talked about many times. It is net income minus dividends, and this is a cumulative amount. So through time it is expected to grow with the corporation. We do a statement of retained earnings. Typically all companies will have a statement of retained earnings because they'll have net income or they'll have dividends with net income, and they'll need to show those changes. So it becomes a financial statement that's issued. Treasury stock we have not talked about. Treasury stock represents the company's decision to repurchase the stock that they have issued in the market. So a corporation will issue their stock, and then they may decide to go out in the stock market and buy back their stock. We'll talk about this a little later, and we'll talk about the reasons why a company would do this. When we buy this stock back, we don't keep it in the contributed capital. We call it treasury stock. We say that because we have taken the stock back and put it in the treasury. This is not the same as a company investing in the stock of other companies. This is a common thing for a corporation to do, to buy into the stock of other corporations. This is not the same thing. In these transactions, we are only buying our stock. So we're buying our own stock. And then the 4th area of stockholders' equity is accumulated other comprehensive income. Oh man, so many words. We call it AOCI for short. This is something that we will talk about if you take other courses in accounting. It's covered in intermediate accounting. For this class, you should just know that it is something where we accumulate a bunch of transactions, and that these transactions are not really typical transactions that corporations see happening a lot within normal day-to-day operations. But it's a caption for an account that takes in a nebulous of various activities. And we put things in there because we are satisfying GAAP, or generally accepted accounting principles. So at this point, you should know then there's 4 parts of stockholders' equity. Contributed capital, which is preferred and common stock. Retained earnings, which is comprised of the cumulative difference between net income and dividends through time. Treasury stock, the repurchase of our stock. And AOCI, which is nebulous of various transactions that we put in this account to satisfy GAAP. The terminology is a bit tricky when we start talking about common stock issuance and authorization and repurchase. Authorization is the number of shares, the maximum number of shares that we as a corporation can issue. Now these shares do not have to be issued. We are only told, according to our charter, that we are authorized to issue a maximum number. So this is the authorization and authorized terminology. From those shares, we can either issue the shares, which means the shares are out there held by stockholders, or we can have unissued shares. And typically a corporation will have some issued shares, but not all their shares will be issued. So part of their authorized shares will not be issued. That's fairly common. And within this authorized share, then, we can have the issued shares on the left side, just as before, and issued shares can either be outstanding, which means they are out with the public. It means stockholders own the stock in our company. We have investors owning the stock. Or we can have recalled those or bought them back, and the issued shares, the shares which we originally issued, can be held in the Treasury. So, once we are authorized to issue shares, we choose, do we want to issue or not issue? We issue some shares. After we issue those shares, we can buy back some of them and hold them in the Treasury, or we can let them remain outstanding with the public. So issued shares will either be outstanding or held in the Treasury. So you can see we're getting back to some more algebraic formulas here. Outstanding plus Treasury is issued, okay? And authorized is either going to be issued or not issued, and they're calling it unissued. So for this terminology then, authorized shares are the number that the corporation is authorized to issue. It doesn't mean that they have been sold or that they've been issued, but they are authorized. Issued means that they were sold. So at some point in time, we did issue these shares. So think of it as a cumulative number, the total amount that we have issued to the public in points in time in the past. Now these issued shares, some of them we can buy back. If we bought them back, then they are treasury, and they're put in the treasury. With these treasury shares, we buy them back. We can then change our mind, or we can later sell the stock that we have in our treasury. So in addition to being able to sell stock that we've never issued, we can also sell stock again that we have bought back and have in the treasury. It's important for us to note at this point that if we start buying and selling our own stock, we can't record gains or losses. Now, you record gains or losses if you buy or sell your assets or liabilities, right? We retired our bonds early, we recorded a gain or loss. We sold our fixed assets, we recorded a gain or a loss. But with Treasury, this buying and selling, you do not get to record a gain or loss. We'll get into that a little more when we start talking about the Treasury transactions. So we're going to have to address in our next audios about how to handle all these transactions that we've only briefly discussed. The last thing we want to talk about though in this voiceover is how these items show up in the balance sheet. So here have a partial balance sheet of a company. It's supposed to be in thousands, except it says except for per share amounts, it's in thousands. There are four captions then, the four major captions within stockholders' equity. We can clearly see. Contributed capital, as I said before, consider it as a gift because we don't have to pay it back. We have this cash coming in, a wonderful thing. And notice within this contributed capital for this corporation, we have preferred stock and we have common stock. We're going to get into this cumulative and par value and all this terminology in a later voiceover, but we do know about authorized and we know about issued. One thing I want you to see here is that they are authorized to issue 75 million shares. They only have issued or sold to the public 50.3 million. So in the future, out of the 75 million, They have almost 25 million shares that this company could still issue in the future and get more cash in for those shares. Now, over here on the right, you see a number 503. This number relates back to the number of issued shares. It's a little confusing when we look at this because we don't know in reading this if they're referring to this number and this number as being the number of issued shares in 2012, or if we're referring it back to the number of issued shares in 2013. Typically, the company will be clear about it and they'll say how many are issued. There is a relationship between the issued shares numbers here and the numbers which show up over here. So I want you to note right now, we'll discuss this further. There's a relationship between issued and the values, the dollar values. Additional paid-in capital, we are going to talk about that when we start talking about transactions. All of this makes up the total contributed capital for the corporation. Retained earnings, we know where that comes from. Net income minus dividends, a cumulative number. Treasury stock, they have bought back and they still hold 4.1 million shares of treasury stock or of common stock they have bought back from the public, and they bought it back at its cost. So this is the value that they now have holding of treasury stock or stock that they have bought back. So they bought back some of the issued stock, and they probably have sold some of this treasury stock, and this is the net amount that they're holding. AOCI is another item that we don't talk about too much other than to note that it's a part of stockholders' equity. If you'll note here that all these numbers are positive numbers except for treasury stock, which is a negative number. Now, since stockholders' equity has a credit balance or is normal credit balance, we note that the treasury stock must be a debit balance. So when companies buy back their own treasury stock, it is a debit to treasury stock. And so this has a normal debit balance in that account. AOCI could be positive, it could be negative, so could be credit, it could be a debit. For this company, AOCI happens to have a debit balance. And overall stockholders' equity is a credit balance, so the total stockholders' equity should be credit. And you should refer back to your accounting equation to think about this. This is assets equal liabilities plus equity. Assets on the left-hand side has a normal debit balance, and equity has a normal credit balance because it's on the right-hand side.